So we are going to go through and have an education session. We're going to do this because over the weekend, there's a mindset shift that has to happen for every trader when you're trading anything, um, when you're doing any type of investing. So whether it's stocks, bonds, yields, real estate, Forex, anything, there has to be a mindset shift that happens. There has to be a state of mind that you're in where you're not phased. You also have to know your basics, and you also have to know what correlates with your market. So since we're talking about Forex, obviously we're going to go through, do Forex stuff with this, but the mindset stuff is definitely stuff that is going to be stuff that carries over. So like I said, market mindset and psychology, Forex basics, and market correlations. Some of these mindset and psychology things, you're going to see they're not like all in order, because I just kind of put them in here as I thought them out. And so I'm just going to get started. All right. So the one of the first things about Forex and the mindset thing is to stop talking about where you have been and start talking about where you're going. So when you're sitting at your computer, when you're sitting on your phone, whatever the case may be, and you're a trader, you know where you've been in your head. Like you yourself, you've already established that. But how far forward do you think you're really going to go if you are looking backwards? If you're looking backwards and you're constantly looking at what you were, looking at where you have been, you're not going to move forward. That's not to say you can't carry forward lessons, but those moments in your past, you can't necessarily be a forward driving person looking in the rearview mirror. All right, so that being said, forgive yourself, because we all make mistakes, and it's about change, and it's about moving on from your mistakes. So no matter where you've been in life, what you did, you have to forgive yourself. And you have to be at a place where you're good, because if you're doing this opportunity because you're trying to prove something to other people, you're already doing it wrong. Because you have to do this opportunity, you have to be in this for yourself. Because if that person goes away, your motive, your desire to do this opportunity is gone. So it has to be for you, because you're always going to be with yourself. Those outside influences might not always be there, so it has to be for you. So if your sentences start with I was, or when I was, or I used to be, stop. Because like I said, how can you drive forward looking in the rearview mirror? When you're in this opportunity, you have to be thinking forward about where you're going. You have to visualize where you're going. You can't always visualize where you have been, because this opportunity is about change. It's about being better. And you're always supposed to be better the next day than you were the day before. So if you're constantly trying to change and get better, you can't always rely on what's in your rear view to help you. That's not to say, like I said, that those lessons don't carry forward, but you can't always continue to look back. You have to aspire and visualize where you want to be, and then that's where you'll go. So another thing about this opportunity is be grateful for that 1% increase in your account, or that $1 that you made. Practice saying thank you after every trade. So it's so easy to look at someone else's profits and be like, dang, they made $200. They made X amount, and then look at your account and be like, oh man, this is nothing. That is something. That 1% increase, or that $1 that you made, is more than what you had before you placed that trade. Even if that trade was a loss, let's flip that around. Even if that trade was a loss, you should be thankful for the loss, because in that loss, you should have learned a lesson. You should have learned something that's going to help to make you a better trader, and something that's going to help to propel you forward to be a better person, to be a better trader, to be a stronger trader, to have a stronger foundation. And then you can layer it with any other like material, learning, teaching that you want to, and then you can teach it to somebody else. You have to have that experience, and you have to be grateful, because if you look at that $1 and be like, oh, this dollar is nothing, how do you think you're going to feel if you grow an account to 100,000 and you made 100 and you're like, oh, this 100 is nothing? That $100 probably was what you initially started that account out as. $100 is a lot for some people. That's a bill. So in everything that you do, be grateful. All right. So know your worth. This kind of goes back to where I started, but know your worth and don't give up on yourself. In those L's that you might take on the other side of your wins, know your worth. Don't give up on yourself, and know that, okay, this trade might not have necessarily gone my way, but I'm grateful. I'm happy. I know I can do this. I know I'm going to be a successful trader. I am a successful trader. I am a great trader. I am a six-figure trader. When you start saying those I ams, you start believing that you can be, you start knowing that you're worth more, you're going to put more effort, you're going to put more time into whatever it is that you choose to do, and whatever you put after that I am. Again, believe in yourself. When you start a sentence with I, especially I am, your brain listens. This isn't, a lot of people start getting really deep into just really deep think. This is true neuroscience. Aside from psychology, aside from being philosophical, this is true neuroscience. When you say I statements, when you, especially I am, because you're talking about yourself, you're talking about who you are, your brain is listening. Your brain is constantly trying to pick up on how you especially perceive yourself, and whatever you say after that I am, your brain believes it, and whatever comes after. So if you say, I'm not going to do this, I can't do this, I'm not capable of this, I'm not as smart as somebody else, you're not going to put forth the effort. Your brain literally shuts down. Like, your brain just quits. It doesn't even put forth any more effort. It literally sends out hormones to dampen your excitement, and you literally have no more desire to do it. So this is literally true neuroscience. When you say, I am a six-figure trader, I am a great trader, I am a successful trader, your brain actually gets excited, and you actually want to work harder towards being what you said you were. So visualize your success. So I have a whiteboard, I have goals, I have my affirmations on my whiteboard. I stand in front of my whiteboard every morning before I go to work, and I say my affirmations. Before I had my whiteboard, I had my affirmations on my phone. I would get in the car and I would say my affirmations before I took my car out of park. I visualize my day. I visualize my success. I visualize where I want to be. And for a lot of the things that have been on my vision boards, I've gotten there because I've said those I am statements, and I've put forth the effort towards getting there. Never stop learning. This one's self-explanatory. Just don't stop learning forever, students. No excuses. Don't make excuses. If you're wrong, you're wrong. If you can't do something, you won't do something. Like, don't make excuses about anything in life, especially for where you want to be and you haven't gotten there. The only solution for that is just to keep working harder until you get there. If you don't desire it anymore, just say that, but don't make excuses. And stop overthinking. This is the one thing that affects a lot of traders: overthinking when to get in, when to get out. A lot of overthinking can be solved with having a trading plan. So the other thing is you will lose because no one is a 100% success rate trader. There are systems and people who are close, but not 100%. So manage your losses and use proper risk management. So FOMO, FOMO will bust your account every single time. And if you're not sure about where the market's going or where to get in or what to do, stay out until you figure it out. There's no sense in jumping into the market and ruining an account that could have been a great account solely because you got scared, you were afraid you were going to miss the move, and who's to say the move already ended and you're getting in on the tail end and the market's now ready to pull back. All right, so if you try to chase the market, you will lose every time. That's another FOMO. Don't chase the markets because the markets will turn around and bite you. Don't chase the markets. And don't trade with emotion. Again, this is FOMO. This is seeing a market movement happen and be like, oh my gosh, like the market's moving up. You could have really gotten FOMO. And a good example of this is earlier this morning around like 7, 8 o'clock when US 30 was like pushing up, and it pushed up for like thousands of pips, like in literally like minutes. A lot of people could have gotten FOMO. They're like, oh my gosh, the market's pushing up. I'm missing the move. I need to get in. I need to catch pips. When you're doing that, you're creating an emotional response around your money. You should never have an emotional response about money. Your thought process about money should be, I have this money. If I let it go, money's going to come back. It's fine. A lot of people can't do that because a lot of people go to work depending upon a job to get the money. And then for most people, they don't have a budget. So when they make money, they don't really truly know how much is going out. And if a lot of people just sat down, had a budget, budgets help to cure emotion when it comes to your money. And then you actually know what's in your account. If you over leverage, you're definitely going to be trading with emotion because you're trading with $100 account and you just put a standard lot on US 30. And now you're looking at the market pulling back and you're starting to see your account go negative. And you're like, oh my gosh, I can't blow this money. I just put this money in my account. Oh my gosh, oh my gosh. Proper risk management is also another cure for emotion. And stick to your trading plan. So if you have a trading plan, stick to it. If you don't have a trading plan, you need to get one because let me see if it's the next slide. Nope. All right. So if you don't have a trading plan, you're planning to fail. If you don't have a plan, you're planning to fail, essentially, because you don't know when you're supposed to get out. You don't know when you're supposed to get in. You don't know what you're looking for in the market. You don't know how many pips you're supposed to catch. You don't know what sessions you're supposed to be in. Your trading plan tells you those things. Your trading plan tells you everything you need to know. So if it's Sunday and the market just opened and all your friends are like, oh girl, or oh God, like bro, I just got into like US 30 or EU or GU. If your trading plan says don't trade on Sunday, you're gonna be like, okay, cool, congratulations. That's gonna be one of those gratitude moments. That's gonna be like the positivity moment for you to spread the love to everybody else. Oh, congratulations. Oh, I'm glad you caught 100 pips. Be grateful and be glad that they're catching pips because they're connected to you. And whatever's connected to you, whatever is connected to them, especially if it's you, that positivity is going to overflow, especially if you're giving out that gratitude and you're giving out that thanks, you're giving out that love. Like, thank you for keeping me informed on your trades. I hope that the rest of your trading night goes well or whatever, because you're going to want that same love whenever you're trading and they might not be trading. But stick to your trading plan, please. because this is going to be a cure for FOMO. Like I said, if they're trading on Sunday and your trading plan says don't trade on Sunday, don't trade. Just because they're making thousands of pips on a Sunday off market opening volatility, don't do it. Why? Because if you bust your account trading when you're not supposed to, you're going to be kicking yourself like, man, my trading plan said I wasn't supposed to be trading, and I did it anyway. Be disciplined. Be disciplined and stick to your trading plan. All right. So break even is better than a loss. This is discipline. This is protecting your account. Knowing, okay, my trade is blue. Now it's my responsibility to protect it. It's my responsibility to protect these profits. If the market is initially going your direction, then all of a sudden news comes out and you've moved your stop loss to break even, you didn't take a loss at all. Whereas if you had left your stop loss at your original stop loss, you've already accounted for that risk, but why take that risk when you didn't even have to because the trade had already gone blue? All right, so essentially with that, your pullout game just needs to be strong. So don't get a one-night stand pregnant. So I'm gonna go back to what this last slide was so we can like put all this stuff together. Move your stop loss to break even. Put a stop loss on your trades. Also, now I'm gonna go back to this slide. All right, so your pullout game needs to be strong. Why do I say that? Because if you're just getting into this trade and you know your first take profit is 20 pips, either you need to have your stop loss at break even or you need to get out of your trade, because if you stay in that trade longer than what you need to, you didn't move your stop loss to break even, or you didn't have one at all, what is going to happen? The market's going to turn around and now you're in drawdown. And now you're holding on to that trade you were only supposed to be in, especially if you're a scalper. You were only supposed to be in that trade no more than an hour, really no more than 30 minutes. But now you're holding drawdown and you're praying, please let me get out of this trade. Oh my gosh, Lord, like I didn't know, I forgot to put my stop loss. Lord, I just really need to get out of this trade, please. And so now you're committed to this trade until either A, you blow your account, or you get stuck funding that account, trying not to get margin called with money you know you can't afford to put in that trading account because you got bills to pay. And then that trade might not even turn around when you could have just did what? Moved your stop loss to break even, or even had a stop loss on the trade. You could have protected your account, and then you could have been in another trade that actually gave you take profit 1, 2, and 3. So when your analysis is wrong, get out of the trade. Your pullout game just needs to be strong. When your analysis is wrong, get out. Don't just pull out. Get out of the trade. Because if you get the trade pregnant and you got to hold on to it, you committed to it. You committed to it until you either holding more drawdown than you want to, or you bust your account. So anyway, aside from that, we're gonna move on. So if you meet your goal, stop trading. Like I told you guys today, I met my goal for trading this whole week. I met it before lunchtime. So I'm not even trading anymore this week. I'm done for the whole week. You got to know when to stop trading, because fear and greed are the death of traders. You will literally watch other people make money and get FOMO and be like, man, I'm missing out on the market. I'm missing out. But what did your trading plan say? If your trading plan said you were going to catch 50 pips a day and you were going to be trading 3 days a week, that's 150 pips a week. When you've met your goal of 150 pips for that week, you shouldn't be trading anymore. I don't care if you did it in the first hour of trading or if it took you to Friday. Like, stop trading after you've met that goal. All right. So, one of the big things we're going to talk about is market psychology. So, market psychology, it really fits all types of market. It fits crypto, it fits Forex pairs, it fits indices. I'm not going to really harp a long time on it, but I wanted you guys to see it. You can Google this picture. It's the psychology of market cycle. But whenever we're looking at this, I really want you guys to see like how the market and then also retail traders like see the market. A lot of people see this and they're like, oh no, whatever. But in real life, when you're in this part of the market here, you start seeing these higher highs and higher lows getting made, and you don't see any of these retests coming back down to the level of hope. People do start getting optimistic about where the market is going. Case in point, this year represents all of this right here. Really, March up until now represents hope to euphoria. Because literally we had the Dow Jones, the US 30 index hit like 18,000. And then now we hit 30,000 today. So, take this into account. I'm not necessarily saying that all of this is going to happen, but, we have talked about it before. But this is how the market really gets your emotions going. Because when the market hit 30,000 today, without a doubt, I'm pretty sure there were people who jumped into the market because they were like, oh my gosh, so excited. The market's hitting these highs. We got this stimulus package. We're getting, not stimulus package, vaccine. We're getting all these different things. And so, yay, the market's moving. But nothing's set in stone. Nothing's ever definite with the market. You just always kind of take it as it comes. All right, so I already said this, trading without a plan, AKA trading plan, is planning to fail. Everybody needs to have a trading plan. Especially when you're new to trading, you need to have it on paper. Have it on paper and take it with you everywhere you go with your trading journal and your log. You shouldn't leave the house without it, especially if you plan to trade while you're gone. It should be with you, because if you're planning to trade, your trading plan needs to be right there with you. And if you haven't done it enough times to know it, then you're bound to get trapped with FOMO. All right, so authors to read for market psychology, Mark Douglas and then Dr. Thomas Stanley. These are two really good authors. If you Google market psychology, these authors come up. They come up in like Kindle searches or Fire tablet searches. Anyway, wherever you're searching for books and you type in market psychology, this is actually their genre of writing. They talk about how the markets play on people's fears of emotion and greed, and how the markets really trap retail traders in. So these are two really good authors if you want to read about market psychology. I don't know why I put that slide there. I'll come back to it. All right, so Forex basics. So this is literally the basics. So if you don't know these things that I'm about to cover, you shouldn't be live trading. You really shouldn't even be demo trading. I say that with the exception of pip counting to an extent, but you'll see why. A lot of these are like the basics. So trends. If you are trading, you should know what an uptrend, a downtrend, and consolidation is. An uptrend consists of higher highs, higher lows, higher highs, higher lows. And then a downtrend consists of lower lows, lower highs, lower lows, lower highs. And then ranging, consolidation, no trend. It's just those equal high or equal low areas, that's what consolidation looks like. It's where there's really no clear higher high or higher low, lower high, lower low. Anyway, those things aren't clear in a ranging market. For order types, so when Mr. Levels puts orders or trades or signals, whatever you want to call them, when he puts them in the group, 9 times out of 10, they're going to be market execution, which means get in the market now. Get in the market now. First of all, you need to look at your chart. And I say that you need to look at your chart because of a few things. You need to realize and kind of recognize how your broker correlates with the numbers he's sending out. So if he gives you a level and you look at your broker and you realize that because of the spread, price is already there or price hasn't gotten there yet, or even so whether it's the price level or the structure, I'm gonna put it like that, you need to check your chart. Anytime anybody sends you a signal, a trade, whatever, you always need to check your chart. You need to check your chart because every broker is different. The charts are going to look slightly different, even if it's the same pair. It's always going to be slightly different because servers are different, banks that they run through are different, the countries that they're based out of are different. So always check your chart. But market execution, if he sends out a buy or a sell, which is what he's mostly going to send out in the group, it means get in now. These order types, buy limit, sell limit, buy stop, sell stop. I put a picture here to show you guys what it means and how you could potentially use them for a trade. Let's say Mr. Levels gives you a level and the market's nowhere near it. You could possibly put an order there, anticipating that the market's going to get there at some point in time. You don't have to use these orders. A lot of times it's better if you're watching the market because you don't actually know what the market could possibly do at that level. But this is what they are. So a buy stop is when price is below the level that you're anticipating that it's going to hit, and you're thinking that, okay, when price gets to that level, it's going to keep going. A sell stop is when price is currently above the level that you're thinking it's going to get to, and when it actually gets to that level, it's going to keep going down. A buy limit is when you think that price is going to go down and retest potentially a particular level and then bounce off of it. And a sell limit is when you think price is going to go up to retest the level and sell down. So don't let these orders confuse you, especially buy limit and sell limit, because all you have to do is just take the word what the order is going to do when it's triggered. So these orders you're putting in, and they're not going to actually start doing anything yet until price gets to where the blue line is. So for a buy limit, just take the limit off. And so you know that when price gets down to that level, it's going to trigger a buy. So if you think that price is going to continue to sell, don't put a buy stop because it's going to trigger a buy. You would want to put a sell stop. And then here for a sell limit, you're thinking that price is going to go up, but then sell when it gets there. So take the word limit off and you know what type of order it's going to be. It's going to be a sell. All right. So stop loss and take profit. So I saw the question in the group chat about stop loss and take profit. So, all right, this black line is where you're actually getting into the market for a buy. So if you're getting into the market and you think that price is going to go up, your take profit needs to be above current price and your stop loss needs to be below, because if you think price is going up, you need to be able to capture money above the price. And then if this were a sell, this would just be reverse. So if you think that price is going to continue to sell, the direction that you think price is going in is where your take profit needs to be. And then the opposite direction is where your stop loss is going to be. All right, trading sessions. This one isn't like, it's important. But one thing I can say, just because of how my schedule has been, is that they're important to know for the sake of liquidity and for the sake of knowing when certain pairs move the most and when you're going to get the most volatility out of the market. So you're going to get a lot of volatility out of the market, technically starting at 3 a.m. and then running through the end of business hours in New York time. So like 5 p.m. here in on the East Coast. But between 3 a.m. and 5 p.m. Eastern time, 8 a.m. to 11:30ish, 12 o'clock, is when you're really going to get a lot of volatility, because that's when both sessions are trading. That's when the New York Stock Exchange opens and the banks are open for business. So anytime or wherever you see these crossovers happening, that's when you get a lot of volatility and a lot of movement in the markets. Same thing for Sydney and Tokyo sessions. When I talk about correlations, we'll talk about Australian dollar and we'll talk about JPY pairs, but that's whatever session is open is when you typically are going to have those pairs moving more, because that's when their banks are open. And then what is a pip? So a pip is a percentage in point. It's how we actually measure price movement in Forex. This is just where the pip is for Euro USD. This is not always the pip. You have to know where the pip is for whatever you're trading, because how are you supposed to know what price level to put your stop loss at and your take profit? And then if someone asks you, how many pips did you catch on that trade? You have to be able to know how many pips you caught, especially if you're trying to make sure your broker didn't cheat you. Not that they necessarily would, but you need to know how to calculate it. So what I did was I pulled up, so this was a trade that I sent you guys. I may have sent this picture out in the group chat earlier today. This other picture was a trade I had running in my demo account. I didn't even know I had it running until I checked earlier today. But we are going to look at these trades and determine how to actually calculate the number of pips. All right, so just because I know with my broker, especially for the indices, a 0.05 is not a 0.05. A 0.05 is really a 0.025 is half of what the actual lot size is, because for my broker, they actually offer nano lots. So you can really and truly trade with a penny if you wanted to with my broker. So when I'm looking at this, I know that much about my trades, but let's say I didn't know. Let's say I was just like, I don't know, and you want to start from right down here. So we're going to look at where I closed out my trade, which was 29,500. And we're going to subtract that from where I actually entered the trade. So this says 959. But what you'll notice with this US 30 for this broker is that they don't offer the pennies. Like on my demo account for Bitcoin, where you actually see the cents, you don't see it here. So you actually have to add a zero. So that's 9,590 pips. But because, like I said, this broker offers nano lots, they don't put the cents on there. So these are things you have to know about your broker. So if someone looks at your trade and automatically tells you how many pips you won or how many pips you got, it might not necessarily be that for your broker. So you just have to know what this is for your broker. So 959 pips. So if I'm looking at this and let's say I'm trying to figure out like what my true lot size is, all I have to do is take what I won, which was my winnings 239.75, and divide it by 959. And so this tells me that each pip was worth 25 cents, which is 0.025 as the true lot size, but it's not going to show up that way, which shows me that like for a lot of you guys, if you go in, I might I'll send out a screenshot so you guys can see it and figure out how to look at it, to know in the details of every pair that's on your list in your MT4, your MT5. It's going to actually tell you what the contract size is. So that way you would know whether or not your broker is cheating you. So I know my true lot size is 0.25 or 25 cents. So let's say I didn't have these numbers down here and I was really trying to figure out what was going on with my trade. I would divide the amount that I won by my lot size. And I know that my lot size worth, I should say, divided by what your lot size is worth. So my lot size is worth 25 cents per pip. I would divide that by what I won, and that tells me how many pips. So if you do that every time, you'll know how many pips. So with the Bitcoin example, because I feel like it's going to be a little bit more clean, divide that by, and I have to move the decimal over because it's not the clean one. It's still the same broker. Okay, cool. All right, so that was it. All right, so there we go. At the end of the day, counting pips is not hard. Most of your brokers don't offer nano lots. KOT does not offer nano lots. Hugo's Way, Trader's Way, Forex.com, none of those brokers offer nano lots. So if you have a winnings here of like $500 and your order was for 0.05, all you would literally have to do is just take your winnings of $500 and divide that by 50 cents. And it will tell you that you won or you were up 1,000 pips when your trade closed or whenever you closed it out. So it's whatever your earnings were divided by the value, the actual monetary value of your lot size. So terminology, I only have a few more slides left. Long means buy, short means sell. When we talk about the spread, we're talking about the difference between the bid and the ask price. So those two numbers that you see in your MT4, your MT5, that's going to be your spread. And then we've already talked about what a pip is. So this is your example of it's not going to look exactly like this, but in your MT4, your MT5, you have a number on the left, you have a number on the right. The difference between those two numbers is going to be your spread. So in this case, because it's Euro USD and the pip is the fourth number after the decimal, your spread is going to be 2 pips. So a lot size, you really should not be trading if you don't know what a lot size is, because this determines your risk management, determines if you're getting ready to blow your account or not. It determines how many pips your stop loss can be without blowing your account. So Forex.com, Owanda, a lot of the US based brokers use number of units, but those number of units convert to these lot sizes. So when I was talking about nano lot sizes and pip values and stuff, this is what I meant. So I'm gonna skip nano because, like I said, I don't think any of you really have brokers that trade nano lots, but a micro lot 0.01 is going to be a 10 cent per pip lot size. A 0.1 is going to be $1 per pip, and then a standard lot is going to be $10 per pip. Obviously, the bigger the lot size, the more money per pip, but you're also risking more money the higher the lot size you go. So whenever you're trying to think about entering and exiting a trade, remember that you need to take into account your spread. And so you don't necessarily have to know, but it's good to know which number you're using whenever you're buying and selling, because you don't ever want to accuse the broker of putting you in at the wrong price and it was just you looking at the wrong number. So yeah, I'm gonna go back here. All right, so whenever you are getting into a buy, your buy is always going to be taken off of the higher number of the two, and your bid price has to actually get to where this number is in order for you to break even. And then when you're in a sell, the price that you're going to be put in at is going to be that very first number. And as the market's coming down, the ask price has to get to this, because you have to get rid of the spread between the two. If you trade on Trading View, or if you trade on your computer with the bid and ask line shown on your chart, you'll see it. You'll see how the two lines actually move, and you'll see the actual spread moving across the price where you got into the market. And you'll see that once where this price is for a buy, you'll see like, okay, I got in at 1053, and then you'll see once the bid price gets to 1053, you'll actually be at break even. This was a slide I had put in. Some of you that have been with us have seen this slide before, but it's kind of like a risk management cheat sheet in a way. Shows you your account size, what your max lot size is for 1% risk of your account. So it just pretty much lets you know that on a $100 account, if you only want to risk 1% of your account, your stop loss can be no more than 10 pips on a 0.01, and so on. Market correlations. All right, so essentially market correlations are super important. So when I'm covering the news, I'm covering the news for a reason, because we're looking for correlations. The news doesn't actually tell you where the market could truly be going, because no one knows. It's just heavily correlated to certain market movements. And so it's important to know your correlating pairs, why they move the way that they do. And if you know two pairs that correlate with one another, like EU and GU, so if you know EU moves up and at some point in time GU moves behind it, then if later in time you see EU move up, you can guess with high probability that GU is going to move up also, because they're correlating pairs. How are they correlating pairs? Because they both share the US dollar and they both trade in the same session. So that makes them heavily correlated pairs. Prior to Brexit, they shared very strong government ties and trading acts and plans and stuff like that. So other things that correlate heavily with each other, Australian dollar and the New Zealand dollar, for the same reason. Their economies are strongly tied to each other and they trade within the same session. Metals, silver and gold, it's going to be super rare that you see silver moving up, gold selling. There might be a lag between the two, but typically they're going to be moving in the same direction. Also, indices. Indices tend to move in the same direction. They might not always do it at the same time, but SPX 500, the S&P 500, the Dow Jones, or the US 30, those two are going to heavily move together. NAS 100 will move with those two, but you have to think about the composition of NAS 100. NAS 100 is heavily made up of pharmaceutical and tech companies. And right now, because of COVID, those things are super volatile. So though that correlation is still there, it just might not do it when US 30 and S&P 500 do. So I know that was long. That's it. That's all I have for you guys. I know there was a slide I said I was going to go back to. Oh, yeah, it was just this slide here about market correlations. There was no 100% correlation in the market unless you're talking about something correlating with itself, which doesn't really make sense because you're always trying to correlate with something else. So always remember there are no 100% correlations. Market conditions are always changing, so correlations change too. And correlations are meant to be a cheat code. So like I said, with EU and GU, if you know one moves and when it's bullish, the other one slowly starts to move and becomes bullish also, use that as your cheat sheet. And the same thing about pairs when they move bearish. It's not always a guarantee, but it's a very strong chance and likelihood because of the connections between these pairs. So that's what I have for you guys. Stop talking your ear off now. If you guys have any questions or anything, you can drop them in the chat. Or I'll let you unmute yourself and you can go ahead and ask them real quick. I don't know if they can they unmute themselves, Mr. Levels?
Yeah.
No questions, but thank you for that information.
No questions, but great information.